The US government has too much debt, but you already knew that. What I'm going to show you today is why that becomes a problem here and now in 2023. Does that sound interesting? Let's get into it right away. What we have today is not a phenomenon just in the United States, but of course all around the world. Governments took on way too much debt. This actually started several years ago during the financial crisis when there was all these bailouts and these countries started to say, okay, corporations, you failed, you did something wrong, banks, you took on way too much risk. Now we are going to accept that in the public sector. The governments did so. And now that puts the basically on your back that you have to deal with this issue because you are the taxpayer and you got to foot that bill. But it becomes more expensive as interest rates rise. Now, why are they going through this whole policy of increasing these interest rates? We're going to talk about that and what Jerome Powell said directly from the horse's mouth. Let me show you. Right here, we begin by taking a look at this, saying that with this whole fake debt ceiling fight on June 2nd, since that moment, which is just 1 month ago, the Treasury has borrowed an additional $700 billion. The national debt's over $32 trillion at this time. I would just imagine that $700 billion in a month. If I asked you, the individual out there, to go on a spending spree, you couldn't even find a way to spend that much money. But in the case of the government, they're going to do that every single month if you give them a chance. That's what's going on right here and now. And it's becoming more expensive to carry that debt. Just like somebody borrowing on their credit card at 20%, that's going to carry on and on and on, and it becomes a very big problem very quickly. Do you see on a smaller scale when you look at that where an individual is just carrying that balance over month to month? Of course that's a problem, of course. So we can extrapolate that into what's happening with the government. Let me show you this. US hunger rates rise as the aid ends. I've shown you this before recently, and more statistics have come out showing what we knew already, because this is information that is pretty basic. As soon as they got rid of all of the moratoriums, as soon as they got rid of all of these different policies that were put in place to kind of make it easier on people, well then guess what happened? All of those statistics started to show up. And this is just one more. It is giving us the idea that people have to spend more money for basic goods. We know that to be the case. And there's statistics I want to show you related to that. America's economic state is uncertain. What's America's economic state? Frustrating and uncertain. The typical American household spends about $768 more monthly on goods and services these days compared to 2020 because of high inflation. Now, I don't know if that statistic applies to everybody, but it's certainly what they say is the typical American household, $768. That's your rent, that's your mortgage, that's your, all your bills, that's everything for the services you use. All in all, $768 more. That's quite significant. And of course, people just you can't keep up with that. The economy is struggling due to these ongoing battles. If you ask the typical American, I think they feel uncomfortable. And that's the issue. But you look at the other set of data around the consumer, and it tells the exact opposite story. What am I saying? Let me show you. US consumer confidence races to a 17-month high. Housing market regaining strength. So even though housing is becoming even more affordable now than it was before, the consumer, apparently, according to the surveys, are saying everything is A-okay. Now, of course, employment, in a sense, their employment stats, they're looking good. They're looking strong. People have 2 and 3 and 4 jobs. They don't seem to have a worry. Oh, but the problem is that they're spending $768 more a month now than they did before. And that, of course, cannot be sustained. And this becomes a big issue for the individuals and the corporations and, of course, the nation itself with what Jerome Powell had to say. Let me show you that right here and now. Powell signals Fed open to 2 straight hikes at coming meetings. Now, to a guy like me, this is huge. Projections show that the Fed officials see rates rising more this year. This was an ECB forum, so you had Christine Lagarde. Christine Lagarde was there, Jerome Powell was there, others were there as well. And basically, you can watch this video for yourself. You need to know what he had to say. Quite frankly, it was that the vast majority of the members of the FOMC believe that inflation is still not down to the levels they need to be at, and as a result, they are going to increase again this year. They will likely be increasing not one, but 2 times. This would be something that the markets did not expect, that businesses are not going to be able to deal with, and commercial real estate is going to get slaughtered even harder than it is today. It's keeping up well, let me tell you. But who is most affected by this? Who stands to lose? Not who stands to gain, but who stands to lose. It is very clear that the regional lenders, the smaller and medium-sized banks, are the ones that are going to be hurt. And they represent a large percentage of the loans here. You believe it or not, it's not as if the big banks are doing all the loans. You can actually look at the data. I've shown it to you here on this channel before, where we have the smaller banks making up a considerable portion, depending on where you're looking at this from that angle or that angle, it's like half. So if they are the ones that are going to get hit, we could have a cascading effect. This is what we have to watch very closely. And if you subscribe to the channel, I will give you all of those details. I promise you're in good hands. So when you hit that button, you're going to get notified about these things coming up in the next few weeks. So what we have here is Jerome Powell partially saying what we knew already, because if you look at what they call the SEP, or the dot plot, and that basically predicts the voting members of the FOMC where they think that this will be. We've heard them talk before. We knew that. However, hearing it in an open forum like this, different story. Going on with that, you can see that despite fears that the potential of global recession, the world economy has so far held up. Underlying inflation has also been persistent across the board. Central bankers were saying that we're determined, but I think that they're a little puzzled that it has seen little effect this far. If you look at core inflation, it did come down year over year, but it seems to have stabilized, and that's the worry. Like, it's not coming down. They said, oh, don't worry, inflation's transitory. Remember that one? Oh my goodness. I can't believe that people actually believed it. I mean, think about all those team transitory people. There were so many economists, there were so many YouTubers that were saying that believed that. And they were also the same people who said they're not going to raise interest rates. All the while, I showed you here on the channel the truth. That's why you're here today, because that was the real stuff. Transitory inflation never happened, never was going to happen. And interest rates did rise. They rose considerably. And the talk is that they will increase them again. So, you believe what you want, but here you're getting the truth. Today's results, this is interesting from the stress tests, okay? Today's results confirm that the banking system remains strong and resilient. Yes, that was the vice chair for supervision, Barr. And I thought it was funny that, they do these stress tests, they bring this out all the time, and they try to suggest to you that everything's okay, but we know it's not. We found that out already back in every other cycle before it. But anyway, I just thought it was funny, so I wanted to bring it to you. The share of non-financial firms in financial distress has reached a level that is higher than during most previous tightening episodes since the 1970s. So yeah, you're going to look at one piece of data and it's going to tell you something. Oh, we did this stress test and everything's fine. But then you look at this, the share of non-financial firms in financial distress has reached a level that is higher than during, all these years. Okay, non-financial, yes, I understand. But what I'm trying to say is the biggest problem right now lies in these small banks, but that's not going to come, it's not going to show up there in these stress tests. And then these companies that are non-financials are already dealing with a problem. So we've got a lot to be cautious about. Just keep that in mind. Doesn't mean you got to go and sell all your stocks. Didn't say that at all. I'm saying be cautious. Watch out. Look into this info. All right. Here we have it. If you look at, this is part of the money mirror method, which is, by the way, also, if I show you right here, that's the money mirror method too, but this is part of it. Just an update. You could see it. This is the one component. And if you look at the blue line, which is the stock market, compare that with the reserve balances at the Fed banks. I talked about this in the money mirror method video that only approximately 4,000 people have seen. Definitely want to check that out. But here we have it. You could see this is just showing us the comparison that when the market, I should say the reserve balances start to decline, then so does the stock market. It works the other way around as well. These things are correlated, as you know, and I just wanted to give you an update on that. However, in the past 2 trading sessions, the market had come up because of why? Artificial intelligence. That's right. Because you're going to see that. You're going to see a lot of, I don't even know how to say it anymore. But we have a little bit of speculation going on today. What you need to do is you need to increase your income and you need to prepare. You need self-sufficiency to some degree, at least, okay? And that's what I love to talk about here. And I talk about that in the pillars of prosperity. So click on this video and I will break it all down for you. Click here. I'll see you over there.